Okay, folks. Couple of reminders again. There are quite a few quizzes upstairs still waiting to be picked up. At this point in time, I've given up on the alphabetical order because you got them. I've done it 3 times already. That's it. I'm done. Right? So find your quizzes when you can. Second, if you've been looking at your calendar, your valuation for your feedback is due about a month from today, I think, or less than a month, 4 weeks from today. So try to get started if you haven't already. And if you have and you're getting stuck, kind of keep moving. Right? So today we're going to complete the rest of the loose ends. So start the class again. Let's do a couple of tests. Right? Let's say you've taken free cash for the firm, discounted them back at the cost of capital, and come up with a value of 100 million. What does that measure? It's a value of the operating assets in your value of the operating assets in the company. Okay? Let's say this company is debt outstanding. The face value of the debt, the book value of the debt is 100 million, but the market value of the debt is 80 million. Why would the market value of debt be lower than the book value? What causes that to happen? Yeah. One is interest rates going up, and the other is distress risk increasing. Either can cause it. So I have a very simple, practical question. You got 100 million as a value of the operating assets. You got 2 numbers for debt. Book value of 100 million, market value of 80 million. Which one should I net out to get to my equity value? If I net out the 80, obviously I get 20 million. If I net out the 100, I get 0. Or maybe the answer is somewhere in the middle. What do you think the right answer is? Should I subtract book value, market value? Should subtract market value, okay? Hold on to that thought. This is one of the messiest things in valuation. And a little later in the class, we're going to come back and talk about this. Because you're right, every textbook says subtract market value. We'll talk about when you're going to be okay with it. But Sophia, would you have subtracted market value as well? Okay. And that's pretty much what every book suggests. We'll talk about when that might get us into trouble and why you might want to kind of deviate from the script sometimes. The other thing we're going to talk about today is stock-based compensation, the most mangled aspect of valuation that I see out there. The things that analysts do with stock-based compensation is mind-boggling. So let's take a very simple example. Let's assume you have a firm that you've estimated the equity to be worth $1 billion. And let's say this firm has 100 million shares outstanding. Let's stop right there and say, what's your value per share? The answer is trivial, right? $10 per share. Let's say that you valued this company at $10 per share correctly. And I now tell you that the firm has granted 10 million additional shares to its CEO. But I also tell you, don't worry, because the exercise price has been set equal to the value per share. Simply saying, no, exercise value is nothing. Therefore, what have I given away? Nothing. But I have a very simple question. What will happen to the value per share with this additional? First, let's get the direction of what the effect is going to be. Will giving these 10 million shares increase my value per share or decrease it? Decrease, because you gave away something of value. The question is, how do we compute that decrease? Look at the choices here. I'll tell you how I came up with the choices, because they're all choices that analysts make. One is to count the extra 10 million shares in the denominator. That's called fully diluted shares, which gives you $9.09. The second is to count the exercise value, in which case nothing happens to the share price. The exercise value is close to 0, therefore. The third is that Correct answer is somewhere between 909 and $10. It doesn't do nothing, and it doesn't just increase the share count. Today, I'm going to give you, I think, what the right way is of dealing with options when you have options outstanding in your company. And we'll talk about why companies have increasingly shifted away from giving options to employees to giving restricted stock. Okay? What are restricted stock? They're shares in the company. But what's the restriction they come with? What are you not allowed to do? Sophia? To trade them. You can't trade them. The wording is unclear, right? I mean that, but this you can't trade them. There's a liquidity constraint. So we'll talk about how to factor those in. So we've quite a lot on our plate. Let's go back. All right. Now, when we talk about debt, there are two places in valuation we encounter debt. The first is in computing cost of capital. We have to come up with a debt to come up with a debt ratio in your cost of capital. And there, if you remember, I said keep it conservative. Don't count everything as part of debt. In fact, I said count all interest-bearing debt and lease commitments because they meet the three core requirements of debt: contractual commitment, tax savings, and if you don't make the payment, you get into trouble. But sometimes you're tempted. Can I add the payables, supplier credit? Don't do it, because if you do it in the cost of capital calculation, you'll actually make debt a bigger number. You'll actually lower your cost of capital because debt is cheaper than equity. So you follow the rule, you come up with the cost of capital using the strict definition of debt, get the value of the firm. And now I'm going to give you a variant of the question, but now I'm going to make it even more extreme. You're valuing a distressed company. You come up with the value of $1 billion for the assets. The book value of the debt is $1 billion. And the market value of the debt is $500 million. Why? Because it's distressed. Very similar to the start of the class test, but I've added distress. The discount is much bigger. Again, if you follow the script of a textbook, it says the value of the equity should be worth $500 million, right? Let's say you're an acquiring company. You decide to pay $500 million for the equity. What's going to happen the minute you announce? The debt's going to go up in price. You're less distressed. Exactly, right? If I'm a healthy company, I buy your company, the minute I announce that, the debt is going to bounce back up from $500 million, and I'm paying $500 million for something that's worth nothing. If you're doing an acquisition, you can very quickly see why, especially if you have distressed debt, you might want to go with the book value of debt here rather than the market value. Let's say you're doing a liquidation valuation. What's a liquidation valuation? You're going to sell off everything the company owns. Let's say you get 1.2 billion, saying, what do I need to subtract out? Now what's the answer? Will the bank take half of what you owe them? They know you're 1.2 billion in cash. They're going to demand the entire billion, saying, hey, I don't care how distressed you are, we can see the cash in your hands. In liquidation and in acquisitions, you should stick with book value. Why? Because it's a clearer thing to do. But if you're a passive investor, where you're investing in the company and the company is going to be a going concern, the market value argument still applies. Use the market value of debt if you're buying 1,000 shares in a company, 10,000 shares in a company, because then you're hoping that as the company fixes itself over time, the market value will go to the book value, but the value of the firm itself will rise. So two sets of rules depending on what you're doing. And we're not quite done. This is your last chance to mop up whatever else is hanging over your head. And I'll give you two things that might or might not apply in your company. Are you familiar with how pension plans in the US are structured? Defined benefit plans and defined contribution plans. Anybody want to help me out on what the difference between those is? What's a defined benefit versus a defined contribution plan? Want to try? Defined benefit. Claire, do you have any ideas? What is the defined benefit, defined contribution? The difference is most plans are defined contribution plans. So you go to work for a company, you set aside money, the company invests your money, and you get whatever you get based on what it's invested. That's a defined contribution. Defined benefit, I promise you a pension. Then I take your money and I invest that money in stocks or bonds, and I try to make your pension payment. So the defined pension plan, the company actually has the obligation to come up with that money. You know, there are, at one point in time in the US, most companies had defined benefit plans, had pensions. Now they've all shifted to defined contribution. I'll give you an example. Disney until 2012. If you joined the company before 2012, you actually get a pension. Post 2012, it's now gone. My son actually joined Disney in 2010. He was one of the last generations to actually qualify for a pension. But if you're an old company, legacy companies, it's entirely possible you have a defined benefit plan. You're saying, so what? In a defined benefit plan, you promise to pay a pension. It's a contractual obligation for all those employees who've retired, right? I look at what you've set aside as money. Could you have set aside enough? Yes. But if you've set aside too little, you've got what's called an underfunded pension plan. So whenever you hear the words underfunded or overfunded, it's always a defined benefit plan. And if you're an equity investor in a company with an underfunded plan, should it affect you? You have an underfunded plan? Tell me what are the two ways in which you can bring it in? It's underfunded, right? So you can treat it like debt. In other words, you have expected cash flows over time. You say, if I'm underfunded, I've got to come up with X million dollars every year for the next 10 years, lower your future cash flows. So you can do one or the other, but it can reduce your value of equity because you have an underfunded plan. That's one thing to worry about. Here's the other. If you're a company that's a target of a lawsuit, in the US, what company is not? You're investing in the equity of the company. Could that lawsuit potentially affect the value of your equity? Absolutely, right? We're writing a case study of a sector that's lived with this hanging over their heads. What would be the example? Pharma, but even before tobacco companies were the original targets, right? Because starting in the 80s and the 90s, once that Surgeon General's warning went on those cigarettes saying it can cause cancer, you had lawsuit after lawsuit after lawsuit. So tobacco companies, and you valued them in the 80s and the 90s, this was a constant issue. Value Altria, or Philip Morris it was then called, find it undervalued. But before you bought the stock, you had to check, how much could this company have to end up paying in legal obligations and lawsuits. Pharma companies, if you remember, Merck had those Vioxx lawsuits for about 7 years, where every month you'd have a lawsuit being settled, either they won or lost, and the stock price went up and down. More recently, I don't know whether you've heard of a company called Bayer. It's a German chemical company. And in 2016, in one of the worst acquisitions that I've ever seen, they bought a company called Monsanto. I'll tell you why it was one of the worst acquisitions ever. They claimed they wanted to consolidate the animal feed business. That's what they claimed the objective was. But when they bought Monsanto, they bought themselves a host of trouble that they could see coming because already it was brewing. What did Monsanto bring into the deal that was potentially a problem? Every time you drive through the suburban US, you see green lawns everywhere, right? You think, how come there are no weeds on those lawns? The answer is very simple. It's a product called Roundup, which landscapers in the US have used for 30, 40, 50 years. And over the last decade or so, you've had these, probably more than that, 15 or 20 years, you've had these cancer cases rising where they've traced it to Roundup. So when Bayer bought Monsanto, those cases were already working their way. And this is going to be a mega billion-dollar problem. It took Bayer 8 years to extricate themselves from that problem. They had to pay billions of dollars, but they should have seen at least the expected outcome coming when they paid up front. You don't know how law cases are going to play out, but it's your job when you are looking at a company and you see lawsuits hanging over the company to bring in that expectation. Do you see what the Justice Department announced about for Google this morning? Now, last year, if you remember, Lena Khan did push they wanted Google to divest themselves of Android and Chrome because they felt that that gave them an unfair advantage. People assumed that when the election was over, that threat was gone. This morning, Sophia, what did they announce?
Been pressuring them to divest from Chrome, the browser.
That they're going to stay with that plan. So if you're valuing Google, will this affect your value? Yeah. You're saying that's going to be really difficult to do. Welcome to the party. This is exactly what you have to face when you value Google. So we have lawsuits that you think will play out affecting your value. This is your last chance to deal with them. Any questions about debt and other stuff that you got to clean up for? For most of you, it's not going to be an issue, but for some of you, this might be something to bring in. Yes. That's a good question. This morning when I did my MBA valuation class, there were two people from the law school who were taking the class. And why they're taking the class? Because they want to be in investing. Why they want to be investing? Because I guess they make more money as private equity or hedge funds than as lawyers. And they want to know what's a niche I can go after. And it's just niche, which is let's face it, predicting how a lawsuit will play out and how much is going to get paid out is not a finance skill, it's a law skill. You got to know how trial lawyers work and how this process and appeal process works. And I said, create a niche business. And all you do is you target companies that have become the targets for big lawsuits. And you track those companies. Because the market overall has no idea what to do with them. So if you win a lawsuit, the price goes up. You lose a lawsuit, the price goes down. But if you're somebody who truly understands the process, you will have an advantage over the rest of the market. So can it be predicted? Yes, but you need to bring in skills from law school, not skills from business school. Which means if you're valuing a company with a big lawsuit, find a lawyer friend, ask them the question. I have no idea. Because it's not just predicting that first lawsuit. Remember, there's an appeals process and what that appeals process would deliver as a final outcome. That's a really messy process to get in. But remember, that's where it's darkest. That's why people give up on these companies, and you might be able to get them at a bargain, especially after a lawsuit goes against a company. Because people sell off, this is your time to get in. Maybe today's the day to buy Google. Is everybody selling off Google? This might be the time to say, I'm going to assess the likelihood of this happening and play it out. So now let's talk about equity to employees. Yeah.
On that, two questions. Number one, if a company has debt that is not callable, if it's private debt,
Yeah.
will I still take the market value of that?
What does it matter whether it's callable or not, right? Because the present value of your obligations just got lower if interest rates went up, right? So you're still making the same payments. I'm not saying you're going to not make the payments, but the present value of those payments now is less than it was before interest rates went up. So let's say you took the private debt in 2020, you got a 3% rate. Guess what? That coupon is low. It's going to give you. So I'm giving you the advantage of the fact that you have low interest rate debt on your books, because it does increase the value of equity in your company, right? Yes, Sophia.
Pension or healthcare plan in depth if it's underfunded,
Mm-hmm.
but what do we do with normal?
Ignore it, because in the U.S. it's a zero. So if it's a properly funded plan, it doesn't affect the value of your equity, right? It's an off-balance sheet obligation that you fully funded. If you have an overfunded plan and you're feeling daring, you might add it on as an asset, just like you did, the Playboy Mansion. You could add on the overfunded pension plan. I tend not to do that because legally it's very difficult to extricate money from it. So underfunding, treat as debt. Properly funded, you can ignore. If you're valuing a German company, anybody valuing a German company? Okay. What you'll notice is pension fund assets and pension fund liabilities find their way into the balance sheet. In the U.S., it's off balance sheet. Only the underfunding gets showed. In a German system, the liabilities you have in your pension fund are shown as a liability, and the pension fund assets are shown as assets of the company. So it's a mild difference about the accounting that you got to keep in mind. Let's talk about equity to employees. I have a very generic question. You run a business. Why would you pay your employees with equity?
Situation that we are executing with your employees and they're more in than they should create.
It's an incentive, right? You want them to behave like shareholders. So part of it is you want them to behave like owners. So it's kind of an extension of a profit share. What's the other? You don't have the cash, right? Let's be quite honest. If you look at the kinds of companies that use immense amounts of stock-based compensation, some of you might be interviewing with these companies. They're going to be startups, lots of potential. They don't have the cash to pay you. They can't compete with a Morgan Stanley in terms of how much they pay in cash, but they can offer you options or an equity stake in the company. So let's get that out of the way. Companies don't grant equity because they're feeling good. They're doing it because they want you to work for them, and this is their way of making sure you do. Okay? So in the next few pages, I want to talk about how to deal with stock-based compensation. Not just compensation that's been granted in the past, because remember, you have two issues to deal with there. One is this company's been doing this for the last 6, 7, 8, 9 years. You have this deadweight cost of past option issues, past restricted stock. But they're not done yet. They might continue to do it in the future. And I want to keep those two questions separate because they might have to be addressed differently. So let's start with the easier of the two problems. If I'm valuing a company, I'd much rather value a company which has been using restricted stock to reward its employees because it shows up as a share count. It's true that you can't trade on it, but it's very much like any other share. So one of the things I would strongly advise you to do is, because companies don't count these shares, they keep them separate, is you read the footnotes, they'll tell you how many restricted shares are out there. Add them onto the share count. Now, one of the things I've noticed when I go to Yahoo Finance or even Bloomberg and I look at the share count, many of these share counts do not include restricted shares, and they should. They're like any other share. The reason I think it's so much easier to deal with stock-based compensation is the shift to restricted stock happened around 2007. And why until 2007 did people grant options? Because accountants made it easy and made it look like you were giving away nothing. Because until 2007, the way accountants dealt with option-based compensation is they valued the options based on exercise value. Remember the $10 option grant? The accountant looked and said, you gave away nothing. What's a million times nothing? Nothing. 10 million times nothing is nothing. So you could give away huge chunks of the company, and the accountant just stood by. In 2007, the accounting rules changed. Now when you grant options, what are you required to do? Anybody know? Yeah.
The treasury stock method?
No, you can't use the treasury stock method. Now you actually have to value the options as options and show them as expenses. So now when you look at the cost of goods sold for a software company, in that cost of goods sold, there will be a stock-based compensation, and analysts don't like this. So what do analysts and companies do? They add it back. This is a stupidity, right? Accountants finally do the right thing. What do analysts do? They reverse it. But that's the reason companies have shifted away from options to restricted stock. You no longer have that freebie that came with options. So let's talk about employee options. Think about why first, as a shareholder in a company, when a company grants options, you have to worry about it. What are the characteristics that make for an option? It's got a finite life. You got a fixed price. And right now, the stock price might be equal to that fixed price. But if the stock price rises in the future, you effectively have to sell your shares at a discount, right? That's really what creates this issue with options. It's not that you've given options and employees can convert to shares, but you can sell it. You have to sell it at a discounted price. So what we're trying to factor in is how much is that potential loss in value going to be? You know, is it possible that I could grant options that end up unexercised? Yeah, stock price drops. An option value tries to capture the expected value of both of those things happening. So when you use an option pricing model, you're capturing an expected value of both the upside and the downside. File that away because I'm going to give you a very simple example, and I'm going to use the 3 ways in which analysts deal with options to show you the different numbers you're going to come up with. Let's say you have a firm with 100 million free cash flow and a cost of capital of 8% and a growth rate of 3% a year. So that's going to give me a total value for the firm of 2 billion, which is just a growing perpetuity. I subtract our debt, I get a value for the equity, value of equity per share. This is the example we started with, right? You give 10 million shares or options in this company, what will happen to the value per share? One answer, the accountant under 2007 said, nothing's going to happen because you've given away nothing. It's kind of absurd because you go to the options market and try to buy an option that's at the money. And you say, look, I don't pay for options at the money, you will never be able to buy that option. There's a price, there's a time premium, and you're ignoring it. The second is that the value per share is going to drop by roughly 10% because there are 10% more shares out there. And the third is you've got to value this as an option to actually figure out what you're giving away. That's the answer I'm going to push you towards, but I'm going to take you through the first 2 approaches. One of which is adjust the share count. The second is called the treasury stock approach, which a lot of analysts like, and what you implicitly assume there. And then we'll look at the right way of dealing with options. So here's the first one. It's called the diluted stock approach. What do? You take the $1 billion you got in equity. And instead of dividing by the actual number of shares outstanding, You add the extra 10 million that will be outstanding if the options get exercised. You preemptively are counting those shares. What does that do? It increases the share count, reduces your value to $9.09. You see what you're missing when you do this? Even assuming that the options get exercised, which is already an assumption, when they get exercised, what does the option holder have to do to actually exercise the options? They have to pay $10, right? It seems to completely miss that because that $10 is going to come in when those options get exercised. So what's the easy fix for that? What can I do to the numerator? I can increase my numerator by the $100 million that I'm going to get. And if I do that, that's called the treasury stock approach. My numerator increases by the proceeds, and I divide by the 110 million shares. I get a value per share of exactly $10. You see implicitly what you're assuming when you use the treasury stock approach? You're assuming that options are worth exercise value. You're missing the time premium. So the first approach, the diluted stock approach, will undervalue your shares because you're counting nothing. The treasury stock approach, where you effectively count in the exercise proceeds and divide by the number of shares, will overvalue the shares because you're ignoring the time premium, which means that there is a Goldilocks solution here, right? Which is if you can somehow value those 10 million options as options and subtract them out from value of your equity, you should be able to get a much better value. So here's in my view, the right way to deal with options that are already out there. Take the option, first value the firm. So don't do any of the stuff differently that you do in the first stage. Free cash for the firm, cost of capital, growth rate, value the firm. Subtract out the value of the outstanding debt. So far, still what you'd have done in any valuation. But before you divide by the number of shares, take the equity, the options, which can include both management options and warrants, value them as options. What does that do? It takes the exercise value, puts a time premium on it. You value them as options. Subtract that value from your equity because you've given it away. And once you've done that, you divide by the actual shares outstanding. So don't adjust the share count. Adjust the equity value for the options outstanding. Why is this better? Because it brings in the time value of money. It reflects the fact that the options might or might not be exercised. And you no longer have to decide which options to include and which to exclude, right? All options will have value, even out of the money options. This allows you to clean up for it. But the only thing is you have to use an option pricing model. Initially, that's what accountants gave as reason for not doing this. Their option pricing models are really difficult to use. Not really. I mean, they've been around for 40 years. You just plug them in. But basically, you're valuing the options as options. Now, you've seen a couple of option pricing models, I'd assume, in your foundations in corporate finance class. No, you don't remember seeing them. You have selective amnesia now. One is called the binomial model, the other is called the Black-Scholes. Black-Scholes is this model with all those terms of ND1, XM. So basically all these, but it's a model that's been around 50 years. Fisher Black and Myron Scholes won the Nobel Prize for it. It's actually a very straightforward model in terms of the inputs, 6 inputs to value any option. But it's a model that was designed to value short-term listed options on traded stock. So it was really designed to value options on the Chicago Board of Options. And we're taking those models and applying them on management options. And here are the things that are going to stretch the model perhaps to breaking point. First is employee options are not 2-month, 3-month options. They're 10-year options. The option pricing models were designed to value short-term options. Why is it a big deal? Because the Black-Scholes model assumes the variance will not change over the lifetime of the option. Not a big deal if you have 3-month options, but much bigger issue with long-term options. Second, when you exercise an option on the Chicago Board of Options, nothing happens to the share count. It's a side bet that you and I are making. But an employee option gets exercised, the share count itself will change. There's a dilution effect that will actually reduce the value of the option, and we've got to somehow bring it in. Third, the Black-Scholes model was designed to value what are called European options. Kind of an unfortunate choice of word because it has something to do with geography. What's the big difference between European options and American options?
You can only exercise European options on the date of expiration.
You can exercise European option the day American options can get exercised earlier. So even without going through option mechanics, American option should be worth a little bit more than European option because you get all the rights that you get with the European option plus this right to exercise early. The Black-Scholes model was designed to value European options. And most of the time we get away with it. Why? Because most options don't get exercised early. I'm going to come back to you again. Why don't most options get exercised early? So let's say you made a bet, the stock price has gone up, it is a call option. Why would I not exercise?
You exercise it early, you destroy the time value. If you can sell it, you can gain the time value and use that money to buy the stock.
Because the options were designed for options in CBOE, people sold the option, they didn't exercise it. On the Chicago Board of Options, 95% of options get held till the very last moment of the very last day. Why? Because you give up. The 5% is usually around ex-dividend day, it's not a big deal. So with regular options, there is no early exercise, therefore you can use the Black-Scholes model. Let's say you're an employee at NVIDIA. You were lucky enough to join in 2019 when the stock price was like $7 per share, $5 per share. Even after the price drop today, it's about $110 per share. But are you getting a little nervous about what the future might deliver? At this point, those NVIDIA options are now worth 2/3 of your wealth. In fact, you borrowed money to buy your house based on the NVIDIA options. You have 5 more years left on the option. You see the temptation here? There's no selling the option. These options are not liquid. What's the only way you can cash out? You're going to exercise the option early. Half of all employee options get exercised early. Many of them get exercised halfway through, 2/3 of the way through, because you can't wait. There's no liquidity. What does that mean? If I use a Black-Scholes model to value these options, I'm effectively assuming they hold till the end and they get exercised earlier. I'm going to affect the value of these options because I'm missing that early exercise. So that became the initial stopping block. You can't use option pricing models because these options are different. So what happened was between 2003 and 2007, when there was talk about valuing employee options, people started fiddling with the Black-Scholes model to adapt it to value employee options. So I'm going to give you the simplest way to deal with many of the issues. First, when you think about a Black-Scholes model, and even if you don't remember it, there are 5 drivers of the option value, especially with no dividends. One is the stock price, second is the strike price, the third is the maturity, the fourth is the standard deviation of the stock price, and the fifth is the riskless rate. Every Black-Scholes model requires that. So if I use the traditional Black-Scholes model, I'm going to use $10 as my stock price, but here's the reason I might not want to. If I go out and exercise this option, with the stock price, it's $10. It's at the money, but the minute I announce I'm exercising the options, what's going to happen to the stock price? It's going to drop. There's a dilution effect. There's a simple way to adjust for it. I've reduced the stock price for the dilution effect. So I've made it a model now that I can value management options. Second, if I wanted to, can I replace the maturity of 10 years with a shorter maturity? Absolutely. I can argue that because these are employee options, even though there's 10 years left, people are often going to exercise in 4, 5, 6 years. I can use a shorter maturity. With those 2 fixes, Black-Scholes models work surprisingly well at valuing management options. In fact, I tried this on the $10 option that I just gave you. The value that I got per option was $5.42. Those 10 million options that I gave that were at the money, with a 10-year life, are worth $5.42 apiece. 10 million times 542 is $54.2 million. That's how much I gave my CEO with that option grant. So if I now subtract out the 54.2 million from the billion, and this is key, once you do that, the number of shares stays at the original count. So don't double count. Don't increase the share count for the number of shares that come from the option. Subtract the value of the equity options. The value per share you get is $9.46. So if you remember the 2 extreme values, $9.09 with the fully diluted, $10 with the treasury stock, this is going to put you somewhere in the middle. And I think it's the most realistic estimate of what your value per share will be if those options are granted. Any questions? Yes.
In restricted stock, do we discount some of it?
That's a good question, right? Did ever get so I said restricted stock are easy. So if I'd granted 100 million restricted shares, all I would do is increase the share count. Is that? But restricted shares, you're not allowed to trade those shares. And if you're not allowed to trade those shares, they should be, at least in theory, be worth less than the unrestricted shares. There are people actually put a discount based on what happens, like 8%. It's not worth the effort. I wouldn't even bother. Just add all the restricted shares in and leave them as a pile in terms of share count. So with restricted shares, adjust the share count. But with options, value the options, subtract them from the value of equity, and take care of it in a much cleaner way. Now, all of this that I've talked about, adjusting the share count and valuing options, is for options and restricted shares granted in the past. But your company is not done, right? They're going to continue to use options and restricted shares in the future, saying, what do I do about those future grants? And here, what Warren Buffett said about options, I think, is worth remembering, especially about employee options. He said, we grant employees options because it's compensation. And what do we do with the rest of compensation expenses? Where do they show up? My operating expenses. They said, well, I don't even know why there's an argument about this. Employee options are an expense that you effectively have to factor in when you think about how much did my company make. That's why I've never understood why there is so much resistance to this idea. You know, what are some of the reasons analysts give for adding back stock-based compensation? Because clearly they must have some reason. They act, so they adjusted EBITDA. Why do you think what's the rationale? It's non-cash. So I want you to get ready for the counter. Because you're going to hear this, right? Don't subtract out stock-based compensation. It's non-cash. We're treating like depreciation. What's the difference, though, between depreciation, which is a true non-cash expense, and stock-based compensation? Yes, Sophia.
You can straight line and you cannot play around with it. Whereas.
Well, stock-based compensation, especially if I'm looking at the past, is basically pretty clear as well, right? I gave, especially with restricted stock, a pretty clear idea of how much I've given away. So.
But then you cannot start to estimate until prices.
But restricted stock, it's not, right? Options, you can argue it's an option pricing model. Yeah.
Options fundamentally take away part of the equity available to everyone else. So it is, in fact, something that's going
It's not a non-cash charge. It's an in-kind expense. Let me explain. Let's say you own a pizzeria. You have 5 employees. You pay them minimum wages because that's all you can afford. They're threatening to leave and go work somewhere else. So here's the deal you enter into. At the end of every day, you're going to hand each employee 3 pizzas to take home. It's a non-cash expense, right? But does it cost you as a business 5 times 3 is 15 pizzas? So if I asked you, does it cost? Of course it does. You're selling fewer pizzas, there's less. So think about stock-based compensation. It's more like those pizzas you're handing your employee rather than depreciation, which is a pure non-cash charge. There's nothing behind it. So when you give away pieces of the company, which is my company, as a shareholder, you give me pieces of my company, don't tell me that, that you're giving away nothing, because that's less of the company that's available to me. In the 1990s, tech companies, young tech companies, the dot-com boom, 20, 25, 30% of the companies were given away as option grants to employees. And after the fact, you realize that that was a problem, because those option grants either got exercised, increasing the number of shares, or these companies had to buy back stock to cover those option exercises out of your cash flows. So there is zero argument for doing what we're doing with stock-based compensation, of adding back the stock-based compensation. It's not an expense. It is an expense. It might not be a cash expense the conventional way, but think of it as just skipping a step. If you had issued the option to the market, raised cash, and paid the employees, it would have been a cash expense. You just skip that step. So when you look at valuing these companies, it looks like you're double counting, but basically you're dealing with 2 separate issues. A company like Cisco has a huge overhang of options and restricted stock from the past, but it's not quite done. They're continuing to do it, so I'm going to punish them twice. Once, when I project out future revenues and cash flows, I'm going to have give them lower cash flows. And then after I value the equity, I'm going to reduce the value of equity even more because of all those options from the past. It's not double counting because I'm dealing with two separate issues. One from past option grants, the other for future option grants. Okay? And, that adjusted earnings game, it's out of control now. You take every company, they have an adjusted EBITDA, they add back stock-based compensation, that's a classic, and a bunch of other things. And I think they're playing to the laziness of analysts. You're saying, what's the big deal about EBITDA? Why do they pick EBITDA to adjust? How do many analysts put a pricing on companies? It's an EBITDA multiple, right? So if I know you're lazy and you're focused on EBITDA, guess what I'm going to do? I'm going to pump up that EBITDA. And that's exactly what they're doing. They're adding up the EBITDA. You apply 8 times EBITDA, and now you're giving me a much higher value because I added it back. So I think analysts get exactly what they deserve. But it doesn't mean the rest of us have to play this game of using the adjusted EBITDA number. Right? Which brings me to my favorite part of this class. Goes back to that very first session when I talked about connecting stories to numbers. If you remember, I said a good valuation is a bridge between stories and numbers. So as you look at your valuation, I want you to think of the story you're telling me. And I'm going to force you to tell that story because that's what's going to connect your numbers together. Because left to your own devices, you're going to play to your strengths. Okay? I'll tell you as a number cruncher what I go back to when I want to add more decimals because I think precision. It's called false precision, but you think if you make it more precise, you feel more comfortable. You claim that you're being objective. Why? Because you're using numbers. As if using numbers removes the being subjective. And you can say, I'm never biased because I'm working with numbers. If you're a storyteller, you have your own set of delusions, right? Including what? You think if you tell a big story, I've got to give you a big number. Could be a fairy tale, but look, I told you a big story. Second, storytellers love anecdotal evidence. They're like my mother-in-law, and I don't mean that as a compliment. Now, I remember this dinner we're having. In the middle of the dinner, she says, we're up in a snowstorm somewhere. She says, the best car to drive in a snowstorm is a Volkswagen Bug. The old Volkswagen Bug. Have you seen these? They're like 300 pounds. You can lift the whole car. And I said, Judy, how do you come up with this crap? I didn't use the word crap. And she told me, she said, 15 years prior, she had been in Lake Tahoe. She'd gone to the grocery store in a Volkswagen Bug, and you could see the story kind of picking up steam. It was snowing. She was driving home. 3 other cars went off the road, but she got home safely. He says, so? See, that proves it, right? A Volkswagen Bug is the best car to have in a snowstorm. Amazing. Sample size of 1. How much you extrapolated? But storytellers love anecdotal evidence. In 1997, I did this, and this amazing thing happened, therefore. So when you look at storytellers, they are going to kind of go crazy. They miss that dividing line between reality and fantasy because nothing is restraining them. So good valuation tries to fight both those extremes. I also, I think, confessed early in this class that when I started teaching valuation, I taught it like a number cruncher did, which is when in doubt, put up an equation. If you still doubt, put up a second equation, make them simultaneous, so it makes you feel much better, even if it does absolutely nothing. It's only a few years into teaching this class that I learned that I had to teach myself storytelling. So I'm going to take you through this process of going from story of what I do when I have to value a company, because I have to force myself to be disciplined to go through this in steps, because if I don't, I'm going to go to a spreadsheet and start working with the numbers. So this sequence works for me. You might find something else that works. So what's the first step in converting a story to numbers? You got to understand the company you're valuing, right? What it does, what it sells, who buys it, why they like it, who the competition is. I call this surveying the landscape, but just a fancy word for do your homework. And much of it doesn't come from looking at numbers, it's from talking to people. So if I ask you what makes Costco special, how many of you are Costco members? Okay. What makes Costco special? No, but think like a customer, right? So to ask you, so why would I go to Costco instead of Walmart?
I get like a free free meal every time I go.
First is there's always a sampling, but the first thing is they're controlled entry, right? Walmart lets everybody in. Who does Costco let in? Only members, already a part of a club. It's a very big club, but it's a club. Costs you $75.
Wholesale.
The prices are good and you're already in there. You're half a mile into the store and you're saying, I'm not going anywhere else. So you take 16,000 rolls of toilet paper and 5 big bottles of olive oil. But you see, to tell the Costco story, it's easy because you kind of understand what the company does. What makes them let's face it, Costco is one of the few brick and mortar retail stores that not just survived the Amazon onslaught, but has survived, but has prospered. So it's worth asking, what does Costco do? So when you value Costco, that's where you're going to start. Not with the financial statements, but what does Costco do that makes them successful? And then you're going to build a story around that. So first step in the process is obviously understanding what a company does. So I'm going to use an example. And this is an example from which one of my books was born, called Narrative and Numbers. It's an example that goes back about a decade. June of 2014. Minding my own business, reading the Wall Street Journal. Actually reading the physical Wall Street Journal. I didn't have the digital edition then. And I see a news story about a company called Uber raising $3 billion from venture capitalists who had priced the company at $17 billion. I'm using every word here deliberately. Venture capitalists priced company $17 billion. And I must admit, I was surprised. First, I'd never heard of Uber. You're saying, what were you doing? Living underground? Yes, I was technically living underground because I was in New York then. I would take the subway everywhere. I never took car service. I should take that back. I'd seen the word Uber in my credit card statements in the 3 months leading into June of 2014. Because my second son was going to college in North Carolina. I was using Uber and using my credit card to back it up. I don't know how this happened. But I thought he was taking German language classes, to be quite honest. No umlaut on the U should have kind of given it away. So I read the story about Uber raising $3 billion, being priced at $17 billion. So I need to know more about the company. I'm curious. So guess who I called first? I called my son, but he was still sleeping. So 11:30 in the morning, but he kept what I call college student hours, which have nothing to do with the sun coming up and the sun going down. That's a different calendar. And he wasn't picking up his phone. So I called my niece who lived and worked in Chicago, and she was technically awake. Why? Because she had a job. Horrible mood. And here's how she picks up the phone. She says, what do you want? He said, have you heard of this company called Uber? She said, it's a ride-sharing company. I said, what the heck is a ride-sharing company? She said, I don't have the time to tell you. Why don't you just download the app and find out for yourself? Hangs up the phone. Should talk to a mother about this behavior. I haven't mentioned it. But I download the app sitting up in my office, and magical things start to happen on my phone. I see a GPS opening up and a car trying to drive towards me. Why in New York City? You don't get from point A to point B. You just try. Go in the general direction, zigzag. I see the car zigging and zagging. And I can see the name of the driver, George. This has never happened to me with a yellow cab. I'm fascinated. I watch George and the car kind of find their way to 44 West 4th Street. I ran and said, hi, George. I wanted to show him I'd seen his name. He says, you didn't enter a destination. Where do you want to go? I said, nowhere in particular. But could you drive me around for about 30 minutes? I have some questions to ask you. He thought for a brief moment I was a serial killer. But then he decided he could take me. He said, get in the back seat. And I started asking him questions. I said, is it an Uber car you're driving? He said, no, this is my car. I said, why do you do this? He said, I have a job. I don't make enough money at the job. I own this car. It allows me to earn a second income to supplement my core income. I said, why do you need Uber? He said, in New York City, it's illegal to stop on the streets and offer somebody a ride. It is illegal, actually. Uber allows me to connect with customers. So I kind of got why this guy was driving for Uber. It allowed him to take a car he already owned and earned a second income. And Uber connected him with customers. He drops me off in front of 44 West 4th Street. I offered to pay him. He should have just taken the money. He said, you don't have to pay me. I said, it's free? He said, it's not free. Do you enter a credit card when you downloaded the app? I said, yes. I said, what happens now? He said, they will charge you. And I said, how do you get paid? He said, they'll send me 80% of the fare. And I remember asking him, why 80%? He said, I don't know, that's what they all do. And he drives off. At this stage, I could see why Uber did what they did. For connecting cars to customers, they got to keep 20% of the fare. Which left me with one final unresolved question. Why would my son and my niece take Uber? To give you some background on my son, he's incapable of calling a yellow cab. It's a very primitive process, right? In New York, how do you call a yellow cab? You run out onto the street, you wave your hands, and you can see the guy changing for hire, not for hire, for hire, not for hire. Then he drives right past you. If you're lucky, he stops. And then you get in and give him a destination. He says, I don't know where that is. Can you tell me how to get there? It's almost like 18th century technology. I mean, that's how we probably called horse carriages in the late 1800s. My son is incapable of doing that. So I want to know why he would use Uber or rideshare. So I called him this time at a civilized hour where he no excuse for sleeping, 3:30 in the afternoon. I knew a basketball game had started and I knew he was waking up for the game, so I caught him right at the start of the game. And I decided to put him on the defensive right away. I said, I noticed you've been using my credit card for your ride sharing. I acted like I knew what he'd been doing. I said, why would you do that? You took a car down with you to North Carolina. Why would you want to use a ride sharing company if you have a car with you? And he said, Dad, on Friday nights and Saturday nights, I really like Uber. As a parent, there's some follow-up questions you don't ask, but I kind of guessed. And I said, that's interesting. What do you like about Uber? He said, I can call the car from the bar. I said, that's a plus. I said, you must wait forever, right? He said, no, they come sooner than a cab. I said, they must cost an arm and a leg, right? He said, oh, cheaper than a cab. The cars must be filthy, right? He said, they're cleaner than a cab. I said, let me get this straight. They're cheaper than a cab. They come sooner than a cab. They're cleaner than a cab. That's what a new cab service was destined for doing. And then the final question was, what's so special about Uber? Why couldn't I buy a really powerful computer, take it down to my basement, and connect cars to customers? And I could think of two things Uber had that I did not. One was $3 billion. They had it, I didn't. What's the other? Well, it's not just a customer base, it's the fact that this is a business with, Sophia, you want to try? What is it about that gives Uber an advantage over any new entrant? That too, so there's a regulatory break the rules first and then ask for permission later. It's called networking benefits, a fancy word for, once you get big in this business, it gets very difficult for a newcomer to break in. Here's why. Let's suppose you have a car and you want to drive for a ride-sharing company. You got Uber, you got Lyft. Let's say I have a new startup that I have. Which one, if I made you pick, are you going to go with the new startup or are you going to go with one of the established companies? Why? Because that's where the customers are. If you're a customer, you can download one app on your phone. Which one are you going to get? You're going to get the one where the most drivers are. It's a system that effectively creates this loop where you're going to, as you get larger. So what does it mean? The end game in this business is you're going to have one or two big players, not 15. It's the economics of the business. That was my research on Uber. You're saying, why don't you look at their financials? What financials? Company was a privately owned company, incredibly secretive. There are only two numbers I knew about Uber in June of 2014. One was their gross bookings from the previous year. And the second was how much money they lost. But let's assume I had access to the financial statements for Uber. What exactly would I have learned from them? There'd be very little there, right? The financials for a young startup tell you very little about the company. It's like a kindergartner's report card, right? If you're saying, look, should I set money aside for college? It's a little too early to make that judgment. What exactly in that report card is giving you away? No. So the fact that I didn't have financials didn't stop me. The other so as I go through, I'm going to try to build on what I've learned about it. So the second stop is you've learned enough about the company. You now have to tell a story about the company, right? Well, remember, you're not a creative novelist. So as you tell a story about a company, don't have people wandering in and out. Just because you have three-headed dogs, you're not J.K. Rowling. You don't need to write a 500-page story. So my advice when you think about a business story is first keep it simple. Yeah. I'll tell you an example of a story you should not be writing. 20 years ago, my oldest son gave me a reading suggestion. He gave me this book. It was 1,200 pages long. And he said, Dad, you got to read this book. It's amazing. And I take my kids' reading suggestions very seriously. And I look at the front of the book. It says, Game of Thrones, George R.R. Martin. And I tried. I read. And about halfway through the book, I called my son and said, Ryan, I'm too old for this. They're like hundreds of characters. They wander on, they wander off, they die, they come back to life. They're good, they're bad. I've kind of given up on this. If you're telling a business story, don't make it Game of Thrones. You don't have 8 seasons and 80 episodes to tell your story. You have like 15 minutes. Keep it simple. Second, keep it focused. On what? What's the end game for whatever kind of business it is? What is the end game for every business? Well, that's a very terminal end game, right? But it is. You guys are giving all the. I think business school has ruined you. There's a sustainability answer. There's the private equity answer. Give me a business answer. What's the end game for a business? Make money, right? So when you tell a business story, at least tell me you've thought about the possibility that you might need to make money. You know how many founders pitch their stories and about 20 minutes in, usually a techie because of amazing software I've written. But 20 minutes and you stop them and say, that's really amazing, but how do you plan to make money? I haven't thought about that, but let me tell you how great my software is and how many people are downloading it. I'm not expecting you to make money next year, but at least tell me whether you want to use a subscription model, a transaction model, because without a pathway to making money, you will never make money. Keep it simple, keep it focused. So I'm going to take my own advice and tell you the story I told for Uber in June of 2014. I'm going to emphasize the dates because this story obviously shifted and morphed over time because Uber has shifted and morphed over time. In June of 2014, my story for Uber, and every word in the story is going to show up in my valuation. So as you track the words, think of how they'll play out in my valuation. Is that Uber is an urban car service company. Do you see already where I see Uber succeeding? What does the urban tell you about where I see success? Cities and big towns as a car service company. Okay? Second, which will expand the car service business by bringing in new users, like whom? Who did I say never would take a yellow cab? People like my son, younger people who could not quite get this 18th century technology of calling a cab would be more likely to take. Third, with local networking benefits. Talked about what networking benefits are. If Uber becomes the largest car service company in New York, there'll be a tipping point where it'll end up dominating the market. But in my story, Lyft can take Chicago, Didi can take Beijing, Ola can take Mumbai, and Grab can take Kuala Lumpur. What does that mean? When I put market shares for these companies for a global market, I can't give any of them 40% market shares. In my, at least my local networking story, you could have 8 or 10 different ride-sharing companies dominating different parts of the world. And I did assume in 2014 that they could keep doing what they were doing, which is they didn't own the cars, and the drivers were not employees, they were independent contractors. And that's going to play out my numbers. That's my June of 2014 story. It's morphed and changed over time, but that's where my story started. So I've looked at the landscape, I've framed a story. The third step is to make sure that I'm not deluding myself. Remember, when you value companies, the person you got to watch out for the most is not me or somebody else, it's you. Because it's easy, especially if you really like a company or dislike a company, to tell a story that you think, okay, I'll let it fly. So what I call the 3P test. Is it possible? Is it plausible? Is it probable? Sounds like I'm playing on words, but each one I'm upping the ante. Possible is the weakest test. Basically, you got to show me it can happen. At least don't tell me a fairy tale, right? If you can pass that test, and I say, is it plausible? Has somebody done something like this? Maybe not in your business, but in some other business. So I've upped the ante. Then if it's then ask, is it probable? You got to show me proof that you've actually pulled it off in some small segment of the market. Possible, plausible, probable. I've wrestled with ways of trying to explain the difference between these 3 words. And about 10 years ago, I was in Latin America doing a series of sessions on narrative and numbers, just this topic. And I had 3 city stop. First night I was in Sao Paulo, Brazil. Second night I was in Santiago, Chile. And the third night I was in Lima, Peru. So I'm doing the same presentation. I'm saying, look, I want to pick something, first night in Brazil, where 300 Brazilians can all relate to whatever I pick. So if you have to pick a topic that 300 Brazilians will all have a point of view on, what topic would you pick, Sophia? Football or soccer? 6 months before the 2018 World Cup, I asked the question, is it possible that Brazil will win the World Cup? You asked 300 Brazilians 6 months before a World Cup, is it possible that Brazil will win the World Cup? What do you think the answer is going to be? Of course, we've won it 5 times before. Then I said, is it plausible that Brazil will win the World Cup? You know what? If I'd asked that question in December of 2014, that room would have been shaky. You're smiling. Tell me what happened in 2014 again. In a moment that they've kind of erased from history, 2014, there was a World Cup in Brazil, and Brazil played Germany in the semifinals in one of the great shellackings of all time. So in 2014, they'd have said, I don't know, we played. But by 2017, they'd regained their confidence. They were second ranked in the world. Yeah, it's plausible. Then I said, is it probable that Brazil win the World Cup? And then you could see the wheels click in. We're in the right group. And Neymar stays healthy and he doesn't flip and flop or do whatever else he does on the pitch. If, then. Take your favorite sport and your favorite team. Is it possible that the Yankees will win the World Series? Of course. It's possible for any team, right? Right now, every team is tied for first place or last place. The season hasn't started. Is it plausible? Do you see the news story? Any Yankee fans here? Did you see the news story yesterday? But Jared Cole, our star pitcher, what was the news story? He might have Tom. Is it now? Is that okay? Now you made my heart drop just a little. I'm holding out hope, but he might have to have Tommy John surgery, which means he's out for the season. All of a sudden, became a little less plausible. Okay? Is it probable? We also lost Stanton just a couple of weeks ago. He's not coming back either. All of a sudden, what looked probable at the start, just a few weeks ago, now is become. That's really what you're doing with the stories. You're passing it through those tests. Is it possible, plausible, probable? So I'm going to give you examples of impossible stories, implausible stories, and improbable stories so you can get a sense of how far people overreach. Let's start with impossible stories. You know what a fairness opinion in an acquisition is? What is a fairness opinion?
Transaction closes an independent bank has to come and review.
Independent, as in quotes, a bank. And what do they have to do?
Review paid a fair price.
In other words, they've got to do a letter saying they pay, that you paid a fair price. And what does that? How does that help you as acquiring company?
Nothing, or rather, it kind of helps you get your legal close.
Exactly. It gives you protection against. So if you overpay and your stock price drops 40%, shareholders sue, you can go to the Delaware courts and say, I have a fairness opinion. In fact, the fairness opinions were born out of a Delaware court case in the 1980s, where the court said, if you get a fairness opinion and bankers sign off, you cannot be accused of fraud or negligence because you did your due diligence. And of course, that's led rise to fairness opinions that back up pretty much every deal on the face of the earth. It's where valuation first principles go to die. Because as a banker, you got to justify the unjustifiable. So usually I read fairness opinions for laughs, because that's what they're good for. So this fairness opinion covered perhaps one of the most conflicted deals of all time. The deal where Tesla bought Solar City. So let's do a test. Who was the largest shareholder in Tesla at the time of that deal? A guy called Elon Musk. Who was the largest shareholder in Solar City at the time of the deal? A guy called Elon Musk. What a coincidence. Same guy, right? Who was the CEO of Tesla at the time of the deal? A guy called Elon Musk. Who was the CEO of Solar City at the time of the deal? A guy called Musk with a different first name, whose cousin. The time this deal was announced, both companies knew they were going to get sued. So they decided to buy protection. So each company goes out and hires an investment banker. Solar City hires Lazard. Go to Lazard, old time New York investment bank, and Tesla hires Evercore, a boutique investment bank. You say, what's a boutique investment bank? It's like a gastropub. You ever walk by gastropubs at airports? Don't walk into them. Because there's this regular burger joints where they triple the price. That's what the gastro, I guess, lets you do. So boutique investment bank does what other investment banks do, but they charge 3 times the price. And both investment banks go to work. What's their job? To justify this deal. It was an exchange offer where X number of shares of Tesla were being given. So basically, both investment banks had to go to the shareholders of the company and say, you got a good deal. Already you can see the tension there. So Lazard does a valuation of Solar City, a pricing of Solar City. And they do all the standard stupid things, like use a multiple for the terminal value, do a little dance and say it's okay. And Tesla was valued by Evercore in what I think is one of the most horrifically bad discounted cash flow valuations of all time. So they take Tesla and they project out cash flows in the next 5 years. And then at the end of year 5, what did they do? What do we do for closure? Estimated terminal value. You can see them reading out of a textbook almost. They put a perpetual growth rate of 6% a year forever in 2016 in valuing Tesla. My first reaction was, what currency are you valuing the company in? Maybe Argentine pesos, and you forgot to tell me? It was in US dollars. The T-bond rate was 2%. You let Tesla grow at 6% a year forever in an economy growing 2 to 3%. What's going to happen in about 10, 15, 20 years? It'll become the economy. Then we go globalize, right? Then 20 years later, it'll be the global economy. Then what? I think we'll have to bring SpaceX into the story and launch Teslas to Mars, right? This is an impossible story. I actually, so if you get a chance, you can go and visit my blog in 2016 when the deal happened. I called this the worst discounted cash flow valuation ever seen. And for doing this piece of crap, you know how much Evercore got paid? $8.5 million. There's no justice in this world. Okay? I actually was in Evercore a few weeks later because I had to give a talk. Get in the elevator, and the 3 bankers involved in the deal got in the elevator with me. I looked in the other direction and said, I don't see you guys. You know, they saw me and they kind of knew who I was. So, they knew. It's just it was just, there was no way you could defend it. That's an impossible valuation. Second, you let your company grow, but you let it grow so much that it kind of becomes, your market share is 150%. We have a problem. Because no matter how great your company is, your market share can't exceed 100%. I'll give you a story to illustrate this. Now, through the last 15 years, Netflix has been a favorite company for people to value for lots of different reasons. So about 10 years ago, midway through the semester, I give this feedback time again, and I get a bunch of company valuations. And one of them is a Netflix valuation. So take a look. This guy's estimated value 4 times higher than the market price. It's a company where you have a tough time getting the market price. He has 4. So I look through the numbers, and I look at his revenues in year 10. He had $600 billion in revenues in year 10. So I emailed the guy and said, could you please come in? I need to talk to you. So he comes in and he says, what's wrong? And I said, nothing, but I want you to lead me through this valuation. I said, do you have Netflix? He said, yes. I said, how much do you pay per year? He said, about $100. I said, I'm looking at your revenues in year 10. You got $600 billion in revenues. How many subscribers would Netflix need to have? He pulled out his calculator, and I said, you don't need a damn calculator. You got 600 billion revenues, and you pay $100 a year. You need about 6 billion people subscribing to Netflix. He said, I don't see where this questioning is going. I said, hang in there. I have a couple more questions, and then we can let it go. I said, how many people are on the face of the earth? He said, I have to check on Google. I said, save you the time. It's about 8 billion people. Is there something you're not telling me? Maybe there's a law that's been passed that says every man, woman, child, and pet has to have a Netflix account and they can't share. He said, don't be absurd. I said, I'm not the one estimating 600 billion revenues. You are. So when you look at your revenues in year 10, I want you to ask the question, are my revenues a number that I can live with? Is there a market big enough to carry it? Because sometimes you can get carried away with those percentage growth rates. Impossible valuation. You'll see a valuation where people cut costs. When you cut costs, will your profit margin go up? Yeah. So year one, year two, then you get carried away and you keep cutting costs and your margin keeps climbing. Just remember, there's a cap on that margin. You can't cut costs. Once costs go to zero and your margins are, again, stating the obvious. Oh, here's a very technical, impossible valuation. I see lots of banking valuations where capex and depreciation are separate line items with their own drivers. And over time, depreciation actually exceeds capex, and they lock that in forever. You see why that's impossible? What do you get to depreciate? Whatever your capex is. How can depreciation be 120% of capex forever? These are impossible valuations. Let's talk about implausible valuations. Implausible valuations can happen, but you got to tell me a really good story, something that backs them up. So it would be an example of a company that grows without reinvestment for a long period. How can you pull that off? Maybe you're an infrastructure company. You've spent the last 20 years building toll roads. You can grow without reinvestment for the next 10, 15, 20 years. You have a company with margins much higher than everybody else's, and no competition is coming in. So you better have a story that fills in the gap. I remember valuing a company called Almarai. Almarai is a Saudi dairy company, food processing company. And I valued one of the things that jumped out at me is the profit margins for Almarai were about twice the profit margins for other food processing companies in the Middle East. So I remember presenting this in Dubai and I said, look, I don't know much about Almarai, but what do they do that allows them to earn these margins that are so much higher than everybody else's? Yep, Sophia, what do they do? Acquisitions actually push the US. When companies do acquisition, their margins actually go down. So it must be acquisitions plus something else, right?
We have a lot of like strawberry milk, date milk.
So one is they've customized. So how come other people are not copying them, right? Milk is milk. You can't patent it.
The only one other that I saw in 3 years in the UAE was
That's my question. Why aren't more new entrants? So I asked this in Dubai, and the person in the audience said, did you check who the top 15 shareholders in Al Marai are? The second on the list was somebody bin Saud. You got the Saudi royal family as a protector. It kind of allows you to keep your competition restrained. So what you're looking for is give me a reason when you plot. Or if you can show me a company that's earning high returns with very little risk, again, I'm going to push back. Tell me what's allowing this company to do it. Maybe it's connections with the government that allow them to charge more than they should and allow them to keep the rates high. Implausible. And improbable, I'm going to introduce what I find is a very useful device when I look at DCFs. What I call a valuation triangle. My valuation triangle has three sides to it. One is growth, the second is reinvestment, the third is risk. So in about on April 3rd, when you send in your DCFs, I think it's a Friday, I'm expecting about 500 DCFs to hit my mailbox at about the same time. And I want to get them back to you by Monday. I don't want them hanging over my head. Saying, how the heck are you going to go through 500 DCFs? I'll give away what I'm going to do. So I'm going to look at your DCF. Obviously, you picked a company. I might not even be familiar with the company. On growth, you can give it high growth, average growth, or low growth, right? So let's pick one. So pick any one of those three.
Low growth.
Low growth. So you pick low growth. I'm not going to contest you on it. It's your company. If you have low growth, then I go check out what you're reinvesting. And if I have low growth, what should I expect to see in the reinvestment? Low reinvestment. And when I look at your cost of capital, your cost of capital should probably be lower than the typical company. Low, low, low makes sense. High growth, high reinvestment, high risk again, makes sense. What I'm looking for is a mismatch. So if you have high growth with low reinvestment, low risk, it can happen, but I need to know what your story is for how this company is able to grow with relatively low reinvestment and low risk. That's what storytelling does. It fills in the gap, says, look, I know this looks odd, but here's why my company can pull it off. That's improbable. You guys watch Shark Tank? Okay. It's all recorded now. You don't even have to watch it live. Here's what I want you to do. Tonight, pull up an episode of Shark Tank, preferably one which doesn't have Ashton Kutcher as one of the venture capitalists, right? The traditional cast. And you know the format for Shark Tank is a founder presents a story, and then the sharks jump in. So I want you to wait till the founder presents a story, then pause. That's the reason I want you to watch the recorded edition. And think of 3 questions you would ask the founder to figure out whether the story they're telling is possible, plausible, probable. What do the sharks have? What is the typical question that sharks have after a story? First is how much money have you made, to see if you have even thought about that. Already about 1 out of 5 founders drops off. They are, really? I'm supposed to make money? Yes, that's what a business is. Growth prospects, what am I going to say as a founder? How huge growth prospects? And they also ask what makes you unique, right? What it might be the form of, did you have a patent? That's one of their favorite questions. Is that the protection? Have you done this somewhere where it works? Can you scale it up, right? I mean, I saw a founder who has a yoga studio. She does really well. She wants to open 50, but it's very personal. So the question I asked was, how the heck do you replicate yourself in 50 other places? Try it out. It's a great exercise in thinking about going from somebody pitching a story. Because to me, this is what makes for great venture capitalists. They ask the right questions. They separate the impossible, the implausible, and the improbable, and try to improve their odds in the stories that are left over. So that's your assignment for tonight, is watch Shark Tank, and then think of yourself as the founder. You're pitching your story to me. I don't expect money to come from me, so I'm not a venture capitalist. But I'm going to ask you questions. That's basically my job, is to probe your question. Not because I think your story is bad, but I want you to check the weakest links in your story and think about how you'd protect yourself. So I will see you on Wednesday.
Thank you.
And then, yeah, let's figure out that.